When
Good morning, good afternoon, good evening, everybody. My name is Wendy Morgan, and I am your host today with the Personal Development and Training. Today, we're going to go through a training, and boy, do we have a really great guest. My dear friend, Clive Gurwitz. He is a CPA, and he has some wonderful ideas how each and every one of us can know what kind of information we're supposed to hold on to when it comes to our taxes, what kind of information, and he's going to teach it all to us. Whether do we need to do we have to have an LLC? Do we, what does an AHA, does it cover the Lifewave patches? We've had so many questions come about this whole entire time through the last couple of years, and here we have an expert to share all this with us. So Clive has actually been a CPA for about 25 years or more, if I recall correctly. And he's also been with direct marketing companies for over 30 years. So he is an expert in this field, and it's such an honor to have you here, Clive. Clive, would you say hello?
Hi, everybody. Thank you. Wendy, can you allow me to screen share?
Absolutely. Oh, wait, hold it. I'm just going to make you co-host, love. So it'll just be easier.
Okay.
That way you can just do whatever you like to do. So Clive lives in California, everyone. And he is, like I said, a dear friend. We just met a couple months ago, and he and his beautiful wife, Martha, become very good friends with him. And it's such an honor to have you. So get your paper and your pens ready, guys, because you're going to need them today.
Well, thanks very much. So just to give you a little bit of background, Martha and I got started in network marketing close to 40 years ago with the first company we joined, and we've been a few companies. We've actually risen to the top of 2 companies and made over $2 million of a career in network marketing. So I believe in the concept, but with the first company that we were associated with, one of our distributors asked me to just come out and do a little presentation on the tax benefits. So that's what I started doing. Can you hear an echo here? Because I'm hearing Martha's computer.
Yeah, just have Martha mute her computer, and she might have
turn down the sound on your computer.
Yeah, she might have to put headphones in so you don't hear the echo. I don't hear the echo, but I'm sure you do.
I'm going to turn mine all the way down. It's probably too loud.
Okay. So anyway, from that initial request, then I got some other requests, and I wrote a book on tax saving strategies for network marketing. And I don't know, it was a booklet, and I sold thousands and thousands of copies, and I did a lot of seminars. So, and with that, I've had many clients in the network marketing industry. In the beginning, that's what most of my clients were, and I've had some people that made hundreds of thousands of dollars, and some people that made just a few dollars. But we're going to talk about the tax benefits, and so I want to give you an overview. If you do have questions, you can put them in the chat. I'll try to look if they pertain to the subject I'm on. I'll try to answer them. But this is not going to be too complicated. So anyway, let me get going with the next slide. So first thing, is that there's a very famous quote by Judge Learned Hand, and that was actually his name. And he said, he was a tax court judge. He said, nobody owes any public duty to pay more tax than the law demands. Taxes are enforced exactions, not voluntary contributions. Now, for those of you that would like to make an additional contribution, there is a place on the tax return where you can actually send some more money in if you think that you're not paying enough. So that should cover for anybody that feels that they want to add something. Okay. So I'm going to go over just about 7 different reasons, and there are lots of reasons why you want to start a network marketing business from a tax point of view. But I'm going to go over some of the tax benefits that and explain a little bit more to you about them. So just an overview: there's income splitting, there's things like buying computers, TV, furniture, travel, if you like to travel, entertainment, using your car for business. And so just give you an example of the kind of expenses you could easily have. And this would add up to, in this example, 17,500. Now, I call these paper tax losses, and I'll explain what I mean by that in a moment. But if your tax bracket is 40%, and some of you are thinking, well, 40% is a very high tax bracket, I will show you that 40% is not a high tax bracket when you consider how the taxes are actually structured. You could save almost $7,000 by just having a business that we're going to be talking about. So I want to just define some common words that tax professionals use. So I call them single A tax deductions, double A tax deductions, cash losses, paper tax losses, and marginal tax bracket. So I'm just going to explain what those would mean. So a single A tax deduction, these are additional expenses you incur because you're in business. So for example, you start your Lifewave business and you order a business cards. Now, if you weren't in business, and let's say it cost you $50, if you weren't in business, you wouldn't spend the $50. So this is a direct expense of your business. So they're deductible, but you actually have to put out cash to create that tax deduction. So I call that a single A tax deduction. Now, what's a double A tax deduction? A double A tax deduction is expenses that you already have that you just convert to business deductions. That could be using part of your home as a home office. And so you're able to deduct part of your home expenses that you were paying for anyway. It may be being able to use your car from going from work back to your home office, which is something you would do anyway, but now you can write it off. So these are what I call double A tax deductions, or these are the kind of tax deductions that you get without spending any additional money. So, okay. Now, then the next thing is we talk about cash losses and paper tax losses. Well, cash losses means that you put cash in and the money coming in doesn't cover the money going out. And so you have a cash loss. And so that obviously would be a tax deductible loss. But it's much better to have paper tax losses. And this is where you have expenses that you would have anyway. It's like I talked about the office and home, or maybe you travel and you combine some travel with a personal trip, but you do enough business to qualify it as a business trip. So we'll talk about that. And then let's just look at the marginal tax bracket. So when accountants talk about the marginal tax bracket, they mean if you earn an extra $1,000, how much tax are you paying on an extra $1,000? Because typically on the first, depending if you're married, $25,000, you're not going to pay any tax if that's all your income. And then on the next 20,000, you'll pay 10%. So if we look at a couple that have a combined taxable income of 90,000, that's after deducting itemized deductions, standard deductions, their federal tax bracket is at about 22%. Now, if you're a wage earner or you're in business for yourself, you're going to pay Social Security, Medicare taxes of ranging from about 8 to 15%. 15% if you're self-employed, about half of that if you work, if you're a wage earner, you get W-2 because your employer will match that. And then depending which state you live in, some of you live in states where there's no tax, some of you live in states with much higher tax. So if we add that all together, it's somewhere between 36 to 43%. So what that means, if you're in that bracket and you earn an extra $1,000, you're going to pay $360 to $430 in taxes. So that's what we talk about, the marginal tax bracket. Okay, now we're going to look at some double A tax deductions, and I've chosen 3 examples here. There are others, but travel, entertainment, auto, and income splitting. And I'm going to go over these a little bit in time. So I want to just put this in a term that maybe you can understand. What if your Lifewave business offered you a travel membership card, and the travel membership card said you could save up to a 50% discount on your domestic travel? So let me put that in other terms. Let's just say American Airlines or Delta or whichever airline you choose to fly said in the week of from October 10th to October 17th, any flights that have a destination of Orlando, Florida, well, you can get up to a 40% discount. Now, if you get a 40% discount on your flights, would you travel? Would that make it less expensive to travel? Would that be an incentive for you to say, I think I'll take a vacation or a combined business trip vacation? So that's what having a business like Lifewave is. Now, let me explain why that's significant. Because most businesses are local. Now, there are exceptions to that, but most people have a local business. So it's in a defined basic area. And so if you were to travel to Florida, which is considered for some people a vacation area, and you live in, say, California, you may not have any reason to go all the way to Florida to do business. But with Lifewave, you can travel internationally, you can travel nationally, because you can open up markets wherever you so desire, wherever Lifewave operates. And so they definitely operate in Florida. So that gives you a great opportunity to travel, if you like to travel, and make most of all your travel tax deductible. Now, there are some rules you have to follow, and I'll explain that in a moment. Okay, so so let me just explain a little bit about the travel rules. So the travel rules, basically, if you travel domestically, okay, there are different rules for traveling internationally, but when you travel domestically, you have to spend more than half the days on business then in order to get all the travel, all your airlines or travel costs deductible. So, for example, if you go to Florida for a week and you do 4 days of business, then the 4 days of business would qualify that your total ticket price would be deductible. Okay, so now what do we mean by business days? A business day is defined as a day where a substantial business discussion takes place. So, for example, if you go to, I'm going to use Florida as the example because a lot of you are going to be traveling to Florida. Now, if you travel to Florida for a conference that's business related, like the Lifewave conference coming up, then it's pretty easy to deduct that travel as a business trip. But what if you're traveling to Florida in February when it's cold and you live up in the Northeast and it's snowing back where you live, but you want to get some warmth, and so you travel to Florida in February? So the rule is you need to, and you're going for a week, you need at least 4 days as business days. So what qualifies as a business day? Well, a day where there's a substantial business discussion takes place with a substantial income incentive. So, for example, if you go to Florida and you have one meeting, and your whole goal is to sell your aunt, I'll call her Aunt Mary, on getting some patches, then that may not be enough of a reason why you would make a trip to Florida, because there's not enough profit on just selling patches to somebody. But if you were going there with the idea that you are going to increase your business and develop an area and looking for people that are going to be brand partners and are going to go on and build a bigger business that you're going to help them do, now you have a tremendous profit incentive. So you can justify that one business discussion that may take an hour that day, as that would qualify that whole day as a business day. So you don't have to work 8 hours. It's really about what you do. So that's how we look at the travel. Now, on hotels and stuff, it would be for the days that you actually do business. So if you take a trip to Disney World, for example, that day would be a personal day, and you wouldn't count the hotel, but you'd still count the flights and etc. Okay, so that covers a little bit about travel. And international travels, it's just got some different rules, and I'm not going to go into that now. Cruises also have different rules. So, but anyway, we'll get to the next thing. So I want to just point out, what if, some of you do commute. Most people, when they first start off in Lifewave, they do have another job, and they do travel to that job. So I know a lot of people work from home these days with after COVID, but there's still a lot of people that do travel. So if you can find a way that you can deduct your use of your car when you go back and forth to work, that can save you, can add up to quite a few $1,000s, because basically you can deduct approximately 60 cents a mile. So if you drive, let's just say 10,000 miles just going back and forth to work, and you were able to deduct that at 60 cents a mile, that'd be a $6,000 deduction. Now, how are you able to convert what is considered for most people a commuting deduction? Well, it starts with an office in your home. And so you need to have an office in your home so that you can start your day from your office. And I'll explain in a moment. Now, if you talk to some accountants or some tax accountants, they will tell you that an office and home is a red flag and you're probably going to get audited, et cetera, et cetera. That, in my experience, that's not exactly what happens. An office and home is not a red flag. There are hundreds of thousands of people deduct offices and home. There are some rules that you have to follow. So what do you have to do to qualify an office and home? So one of the things that in order to qualify an office and home, under the old rules, and this is pretty old, you had to have a dedicated area. So if you use one bedroom, you could use it as an office as long as you never used it for anything else. But the rules got changed, and it said that you just have to have a dedicated area. So you can use 25% of a room or 50% of a room, as long as that particular area is dedicated as your office. Now, what's important here is not so much how much space you use, but once you have an office in your home, then you can start your day by going to your office before you go to work. Now, for most people, this is not hard to do because we want to check our emails. We want to check up on our volumes. We want to check up on orders. We want to do follow-up. We may have to send somebody an email. So you can easily work it out that you can actually go to your office first before you go to your other job. Now, if you're on a shift, for example, and you start work at 3 o'clock in the morning, then it's probably not that practical for you to go into your home office at 2 o'clock in the morning and do some work. It's not impossible, but it's not that practical. So again, so the rule is as long as you go from your office to your other job, that would qualify as a business expense, as a deductible expense. And coming home from your work, so what you do when you leave work, you don't go straight home, you go straight to your office, and then you go home. So that's how you can qualify your mileage. Now you're going to have other mileage too that when you go and do a meeting, you go to an event, you may travel to do a trade show, etc. You're going to count all those miles as business miles. Okay, so I'm going to move on to something about income splitting. So income splitting is actually quite a tremendous way of shifting some of your income to members of your family who are in lower tax brackets than you are. So if you have kids that can work for you in your business, now it depends what they can do for you. Now, even if they're young, some of their computer skills are so far superior than yours that you can hire your kids to help you work in the business. So if you pay your kids, and there are some rules attached to how you have to pay them and stuff like that, you actually can shift that money to them, and they can obviously do whatever they want with their money, or they can start to put it into a college savings program. So now one of the other benefits you can do, especially when your kids are at the college age or getting to that point, is you can sponsor them as a brand partner in your business, and you can help them develop a business. And one of our sons, we have three sons. They all went to college. 2 of them went in-state, but one decided he was going to go to Colorado, and so he transferred to Colorado. But fortunately, at the time he did that, he already had a network marketing business that was earning him about $30,000 a year. And so he was able to establish that he was independent. and that he could then get qualified for in-state tuition, because Colorado University out of state is $40,000. In state, it's a heck of a lot cheaper. And he had the income to support himself. So, you know, if you have kids that are getting ready to go to college, start the process early, help them build a business. They can have income that will help them pay for their own college costs. So that's another way you can do it. So you can either hire them to work for you, or you can help them start their own business and create a cash flow income that can support themselves. Okay, so I've covered a little bit of that, and you can see you can start early. This may be a little too early, but you know, sometimes some of you have exceptional kids, so everything is you have to be a judge it personally. Okay, so I covered a little bit of that. Okay, office and home I talked about. Now this picture actually is where I grew up. I grew up in South Africa. We moved around quite a few houses. This is one of the houses I grew up in. At the time I grew up there was no swimming pool, because this is in a tropical area. It's actually in the city of Durban, which is on the Indian Ocean. So we went to the beach, and when I grew up, nobody had swimming pools, but times have changed. Okay, so when we look at some of those deductions, now we talk about computers, furniture, all these things that you use for your business can be deductible. And so I just wanted to give you a kind of an overview of what it is. And then I know we have a few questions. I'm going to take some of those questions. Wendy wrote some down. I'll address some of those. And I just want to leave you with this as, you know, many of you probably, some of you may be doing your own taxes. Some of you may be using an accountant. Some of you may be using TurboTax. The real thing about when you have your taxes prepared is whoever does it, it's really about what questions they ask you and what information they get from you that you don't give them. You know, most clients will give you the information they think you need, but usually there's a lot of other information that will make it much more possible for you to save a lot more money in taxes. So, you know, don't be afraid to ask your accountant. And sometimes I think what you have to do is you have to know some basics that you can go back and say, how come I'm not deducting this? Or how do I deduct this? And I heard you can deduct the office and home. Why am I not deducting it? So, you know, don't just take everything for granted. And basically, the other part of this too is that, you know, most accountants, because of the way the tax system is, it's a very compressed tax season. And so there's a lot of work in a very short period of time. So if you haven't done some planning beforehand, most likely when you go to get your taxes done, they're going to take your information, they're going to get it done and give it back to you without asking a lot of questions or taking a lot of time, which they don't have. So it's going to be up to you to actually do more to come up with the ideas, the suggestions, and have the records to back it up. Okay, so I want to just address some of the things that Wendy set up. And she said, what do I need to keep track of? So so when I first started, this was a while back, and I still have it. I have a tax drawer in my office. I have one drawer that I put anything that I think is tax deductible, I put in the drawer. So at least I have everything in the same place. And so whether you think it's tax deductible, I'll keep many records as I can as far as that goes. Now, what I do today is, and I'd recommend this just about to everybody, everybody should buy a scanner. It's tax deductible. They're not that expensive. And you just scan everything in because it's a great way to keep records. It's a great way to find records. You can store everything in the cloud. You don't need boxes of stuff. Now, why do I say you need to keep as many records as you can? At the present time, audit rates of taxpayers are pretty low compared to what they have been. A lot of auditing is done by computer matching, which the IRS is very good at. So if somebody sends you a 1099, if Lifewave sends you a 1099, there's probably a 99% chance that it's going to be in your record that you received that money. So they will match stuff like that. And so that because of their matching programs and also because of their budgetary programs, they are so far behind, they're not auditing as many people physically. But that doesn't mean that you're not going to be audited. So the only thing I can tell you from my experience is if I'm going to have an audit, I want to go in with not just a small envelope of receipts. I want to go in with a few boxes of receipts. And I find that it works better when I arrive with a few boxes than when I arrive with a small envelope that can be dealt with right away. Okay, so keep receipts of everything. Now, there are some rules here in terms of keeping receipts. If it's under $75, you don't need to keep a receipt, but you do need to have a record of what you spend money for. So if you go to, if you buy something, I just find it easier to keep a receipt. Now, some people will ask if I pay by credit card, is that a good enough receipt? And for a lot of times, it's not a good enough receipt because the credit card doesn't have enough information. So let's just say you bought a scanner and it says on the credit card that you bought it from Amazon. Well, that credit card statement that says $342 Amazon doesn't tell you what it's for. So you want to keep track, you want to keep the receipt as well that shows what you spent the money for. When you go out to a restaurant, so I want to give you a little clue about meals because I didn't really touch about meals too much. Meals can be deductible. So when you travel on business, whether you eat by yourself or you eat with other people, it's a deductible business expense. Now only 50% is deductible. There was the last couple of years allowed to deduct 100%, but it's going to go back to the 50% rule. But what basically what the rules with meals are is if you're in your local area and you go out for a meal, you need to have a business discussion that takes place. There needs to be a business purpose to having that meal. So you can go out with somebody that's a brand partner because you want to show them how to increase the income, what they could do more, what they could do, make their business more efficient, for example. You could go out with somebody that you're talking with, that been trying to encourage to become a brand partner. These will be legitimate business expenses. So what you need to do is you need to keep a receipt. So on a receipt for meals, there's basically 5 things you need. You need the name of the restaurant, the location, how much you paid, and what was the business purpose? What did you talk about? So I would just encourage people when you write down what the business purpose is write down enough information that, and it doesn't have to be that neat, but I want enough information, not that neat. I want to make it so that it's not difficult for somebody to read. And I'm only talking about a certain person that maybe auditing you, but that they have to work to read the information, because the more my experience is the more you write, the less people read. So it works to your advantage in keeping records. One of the questions often comes up, do I need a separate bank account? Do I need to have a separate checking account for my business? You'll hear this, a lot of businesses do have separate checking accounts. So it makes sense to have a separate checking account. Does it matter if you don't have a separate checking account? You can still deduct all your expenses, whether you have a separate checking account or not. It just may make it easier for you to have it separate. Same thing with a credit card. If you have one credit card you use for business, it just makes it easier to track it. If you use multiple cards, it just needs probably a little more tracking information to track all the expenses from the different cards. Okay, as far as 401ks and IRAs, these are options that you can put away money for retirement. And one of the nice things today is that even if you're in a low tax bracket, and previously you wouldn't bother to put money away into an IRA or 401k account, but you can have something called a Roth IRA, which basically is you put the money in and it grows tax-free. When you take it out, it's all tax-free. So for even people that are paying substantial taxes, you may want to consider doing a Roth account. or a combination of Roth and a regular IRA account. So there are some limitations on Roth accounts. There are some ways around that. One of the nice things about being in business too is that you can set up your own 401k account. And that is a way to actually put quite a bit of money into. You can put up to $61,000, depending upon your business income, etc., into that account. And so that could be substantial. Just going to cover this LLC account thing that a lot of people will hear about setting up LLCs. One of the reasons to set up an LLC is not really a tax reason. It's more to do with legal liability. That what can people sue you for? So it's the same thing with a corporation. Tax-wise, it probably won't save you any money. It will probably cost you a little bit more money in terms of tax preparation and some of the rules you have to follow. But I'm going to leave that for a little more detailed discussion of when you should set up or not. But when you first start, I would say that you want to encourage brand partners to start with the easiest setup. You don't want to confuse people and tell them they're going to need to set up LLCs. They need to do a whole lot of stuff to get started, because one of the things that you'll find is if it's too complicated, people will just stop or will not get started, or will just be worry about all the other things they have to do. So in terms of keeping track of your business, you want to try to make it as simple as possible to keep track of things, because you don't get paid to do bookkeeping. You know, nobody's going to pay you to do bookkeeping, but you have to do the minimum set, but you want to do it in a fashion that can make the most, so you can spend your time building your business. I'm going to open up for questions, but before I do that, I just want to share with you one thing here, is that the bigger your business, the more you can write off, the more expenses you can write off. The easier it is to write off more expenses. You know, if your business is making $100,000, it's easy to write off $10,000 or $15,000 expenses. If your business is making $1,000 a year, it's not that easy to write off $20,000 expenses, because, you know, there's a limit to see if it's justifiable. You know, would you lose $20,000 to make $1,000? Well, maybe in the first year, but you wouldn't keep doing it. So there's something called the hobby loss rules that you should be aware of. And basically the hobby loss rules is that you need to show a profit at least 3 out of 5 years. Now, why is that important? Let's say year one, you pay your kids, you travel for business, you bought some equipment, and you end up with a $10,000 loss. But your income was only like $300 because you weren't that able to get too many brand partners. You didn't show up at the office that often. And so you didn't do that much work, but you had all these expenses and had good intentions. Well, you may have a loss for that first year of $10,000, and you may have a loss the second year. But in the third, fourth, and fifth year, you need to show a profit. Otherwise, you can jeopardize all the losses that you've shown from the prior 2 years. So what I want to encourage you to do, you know, Lifewave is a tremendous vehicle to make income. It's, in terms of my experience with network marketing, the compensation plan, the way it's set up is set up so that you're in a position to create income without creating a lot of debt to go into it, because you don't have a lot of expenses to start with, other than the AA tax deductions that we talked about, how you can do that. So I'm just going to look at the chat here and see.
Before we go to the chat, I did stay on this. Any questions? So what do I need to keep track of? So and Jenny went and asked, yes, you keep track of your restaurants. You write everything down from the name of the restaurant, which is usually on your receipt, location, how much you spent, the business purpose, and the name of the brand partner. As Clive alluded, the more you put on there, the better. And I'm going to back up Clive. It is so important to scan this, or at least copy onto a piece of paper, because everyone puts it on these carbon, printouts from your from restaurants. And we have to keep our receipts for 7 years. Those receipts will start to disappear ink will go away within a certain short amount of time. So always do either copy it or scan it into your computer is so important. Also, when it comes to what do I need to keep track of, I've got some questions here is asking, can I deduct clothing that I buy specifically to go to some of these functions or to go to a business meeting, etc.?
Okay, so clothing comes up quite a bit. So the rule for clothing is if you can wear the clothing for normal everyday life, whether you would wear it or not, then it's not deductible. So, for example, if I have to buy a business suit for a presentation, that's not going to be deductible. But how do you make your clothing deductible? If you put your a Lifewave logo on it or the name of your business on it, so let's say you have a jacket or a sweater or a shirt that you can put something to do with your business, then it becomes a uniform. But if it's say you need a new outfit for a presentation or a gala event or something like that, that's not going to be deductible. But anything that you can put a logo on or your name on, or then it would make it a uniform. So that's how you would deduct some of the clothing that you may do. The same thing comes with, what if I have to get my nails done or my hair done because I'm the presenter at an event? So again, those would not be deductible under the rules of basically that, it's something that people do anytime. Now, if there's some event that you buy some outfit that's specifically for that event that you never, I'm not even going to go there because I don't think it matters. There's differences for people that are in the acting field or the entertainment area. There are some different rules for them, but I would say for most people that's not going to be a big item.
Okay, I'm going to go to the next question. What external accounts do I need to set up? So as Clive alluded, you can use your checking account, you can use a certain credit card or a complete separate checking account. It just makes it easier to keep it all in one spot, but doesn't mean necessarily you have to. But focusing on external accounts, I know health savings account will come up because a lot of people do have their health insurance and they opened up a health savings account. And I've seen this question so many times in the Telegram, which is, can I pay for the Lifewave patches via that health savings account?
Okay. So this also comes up with the question of, your automatic reorder that you have to do to maintain your status or maintain your points. So you'll hear a lot of advice that people give that is not supported and I don't think will be supported. So I'm going to address first of all the automatic reorders or the AROs or the order ship. When you're ordering product, if you use that product personally, it's not a business expense. It doesn't matter that you have to do it because that's a requirement in order to maintain your points or to be paid. The end result is, what did you use the products for? Now, if you whatever products you purchase and you use as samples, or you give them away to encourage business, those would be deductible business expenses. Now, if you give samples, let's just say you give samples to your kids and you give them $100 of samples every month and you call it samples, that's probably not, it's definitely not going to fly as a sample expense. So, obviously you can give product away, but it depends who you give it to and what's the purpose of giving it. So samples would count, but just because you place in an order that you may be required to place, that will not qualify as a business expense. Now, in terms of, I think what was the other question you asked?
The HSA, so health savings account.
Okay, the health savings account. Okay, talking about the patches for the health savings account. So first of all, in order to set up a health savings account is another great mechanism. There are some rules about what you have to do to set it up in order to do that. And the question then becomes whether the patches would qualify as a medical expense. Now, if you give product away, but it depends who you give it to and what's the purpose of giving it. So samples would count, but just because you place in an order that you may be required to place, that will not qualify as a business expense. And so they you know, I'm gonna the normal thing would be these wouldn't qualify as medical expenses because they are not at that qualification. They're not prescribed. In terms of the HSA plan, you have to look at what your criteria in your HSA plan is. If the rules in the HSA plan, and I will look this up, and another time I'll come back to you with more specific advice. If that allows for over-the-counter medications, then maybe that would work, especially if you have a condition that you're trying to treat with that. And of course, if you had a prescription from your doctor, that would probably help as well. But I'll get back to you on that, Wendy, and give you a better answer.
Okay. All right. And then let's go ahead and go into the chat and see here the top question. There we go. What percentage of patches can be written off, assuming they are given a sample? So you already answered that question. Next question. Sorry, I'm just trying to scroll down here. If I'm having a home patching party and refinish my furniture to have it look nice, can I deduct that? Also, can I deduct patches that I'm wearing myself? That's already been answered. Or those that I'm giving away. So that's been answered as well. So can she deduct her furniture that she refurnished to look nice for her party?
Okay, so in order to deduct that furniture, you know, you probably have to, obviously, if you buy a chair for your desk that you use in your office, that's pretty clear that would be tax deductible. So if you use a furniture, you know, you would have to, now if the furniture got damaged because somebody spilled something on the furniture, obviously the repair would be deductible if it was caused from a business event. But I think just to buy new furniture that's used not exclusively for your business, that would be pretty hard to deduct. But while we're talking about, say, your home patching party, you know, what I would suggest you do too is to keep track. You're probably going to provide some refreshments, depending how extensive it is. Keep track of any refreshments you buy, because that would be a tax deductible business expense. Again, you may invite people over for dinner in your home, and then have a meeting afterwards, or a business presentation afterwards. So those costs of that expense could all be tax deductible.
And Clive, since you're having it in your home, and you say you have an office as well in your home, can you not also deduct part of your utilities for supporting that business and the patching parties?
Okay, so first of all, let's you determine how much office you're using in your home. So let's say it works out to about 10%. So typically you would take 10% of the utilities, 10% of your insurance. If you're paying rent, 10% of your rent. If you're paying a mortgage, 10% of your interest, 10% of your property taxes, any repairs that apply to the whole house. For example, let's say you live in a house and you have to repair the roof, then it'd be 10% of the roof. If you have to repair the bathroom, probably not, unless it's a dedicated bathroom for your office. Now, some homes that would be the case. So it just depends how big your house is and how much space you can do. But all those would be qualified home office expenses. There are some limitations on office expense, but even if you can't deduct in a particular year, you can carry it forward to another year when you have more income.
Got it. Beautiful. All right. Jenny has a question. What are the pros and cons of having an LLC? Like I've been told, if you do get an LLC, then you basically are paying yourself and the business. So there's like a separation. And can you talk a little bit on that?
Okay. So when we talk about LLC, first of all, there are different kinds of LLC. So if you open up if you typically, let's just say, I'll take Wendy as an example. She has the business, it's in her name. She's the only person in the business. She opens up an LLC. For IRS purposes, that LLC is actually considered to be a disregarded entity. So you just report everything on your tax return exactly the same way as you did it without having the LLC. And for the state, the rules basically follow the same. So you still would, ideally have a separate check. You would want to have a separate account, because the reason for having the LLC is to protect you in case somebody sues you. Now, an LLC is going to give you some protection if you owe people money for debts you may incur in your business. But in a typical Lifewave business, you don't really have that many debts in your business. It's not like when you buy a product from Lifewave, you're paying for it. You're not getting it on credit. So, and if somebody comes to your home office and they trip and fall and sue you, then what one of the things I do recommend, you should have insurance obviously for your home, but you can have business insurance that will cover you in case somebody falls or trips when they come to see you for business purposes. But your LLC may cover you for things like that, but it's not going to cover you if for most other expenses. So you have to look at it and see, what's the purpose of having an LLC? What am I trying to achieve? Now, if you more than one person, then the LLC will be a partnership, and so you're going to have a partnership entity. So again, with the LLC, it depends if you want to be a corporation or just going to operate as an individual. So it's not sort of straightforward, but the thing I would say that is straightforward is, don't just take the advice that people tell you about setting up an LLC without maybe talking to your accountant and seeing what does it actually save me? What's the purpose of it? What am I trying to achieve by doing it? Because tax-wise, you're not really going to get any greater tax benefit from it. Now, is there a reason to have a corporation? I think there is a reason to have a corporation especially when your income starts to get up there. And this has to do with once your income is $100,000 in a Schedule C, there's a greater risk of being audited. The percentages go up. It's not that much more, but it does go up. Whereas as of now, and as of the past few years, the percentage of corporations that are audited is far less than, say, a sole proprietor having $100,000 of income. So there is a reason to set up a corporation, because there are maybe a little easier to get things deducted. There's also more benefits, and sometimes in pension plans that depending upon your income. So I would basically look at the income you're making, and then decide if this is what am I going to achieve from it? What are the benefits that are going to get tax-wise, other than liability issues?
Okay, beautiful. Jenny asks, if I patch someone for my own supply, basically she's, how can I prove it, or am I to prove it? I would presume that you just kind of guesstimate a percentage of what money that you used on people. Okay,
so the thing to do is, so you're going to give out samples and stuff like that, so you're going to patch people. So I would probably say just keep a record. That's the best way. So you would just, if you have a calendar, whether it's paper or digital, you could just put in the calendar, I patched Wendy and I gave her 4 patches. Okay, and you'd have it be on that date, and then you may estimate how much you gave away in samples and it will patch in during the course of a year. But if you ever ordered, you could go back and say, well, here's the people I gave it to, or I have, at least I can show that this is the way I operate and do business. So it's not that difficult to do. If you are doing follow-up, it's really good to have records of what you do with people, when you actually talk to them, what you've sent them, if you've patched them. So if you just include that in the way you do business, those records will actually help you in dealing with people. It's not really any different when I talk to a client doing their taxes. I make notes what they tell me. They may tell me about stuff that doesn't affect this year, but I'm going to put it in their file. I'm going to put it down. And so the same thing when you're talking to your prospective brand partners or customers, you just have a record, and there's great technology out to do that. Or whether you do it on paper, just jot down the information. You patch so and so, and maybe you don't have to say I patched them exactly what you did. You patched because you could basically rely on the fact that everybody you patch with Lifewave and Eon, for example, or whatever your system is.
Got it. Beautiful. Just Debbie said, what is an LLC? That's a limited liability corporation. Is that correct, Clive?
A limited liability company, because it does. So a limited liability company can be a sole practitioner, a sole person. It could be a partnership, and it can also be a corporation. So just aside, so the one point of view is, should I set up an LLC or set up a corporation? One of the differences between an LLC that's operating as a corporation is that corporations are required to keep minutes. LLCs do not have that requirement. So if you think about keeping minutes, keeping minutes is easy for big corporations. They have so much people on staff that people are paid to do it. But if you're a one-person corporation, you're doing everything, the last thing you want to think about is doing minutes for your corporation. So that'll be part of the discussion, whether you should have a corporation or not and how to set it up.
Okay. Now, Julie has a question. It seems rather convoluted, so if you want to talk to her privately, great. But her question was, so her husband's Lifewave account is under their trust fund. And she also is a brand partner. So she works her husband's business, so all the expenses are in her name. Can we claim the expenses in my name on Schedule C? So Julie, would we like to have Julie come forth and kind of clear that up, Clive?
I think I understand what you're saying, which is that the business is in a trust name, but the trust basically that you're probably talking about is probably a living trust, and a living trust actually doesn't go into effect until you pass away. So it's a tool mostly used to avoid probate. It's a way of passing on an asset without a lot of legal paperwork involved, but it actually doesn't take effect until, even though the name is in the trust, everything gets reported under the person whose trust it is. So that's one part to that. So when you have, for example, a husband and wife, and they, and you've got two different businesses in effect, I would say that you would actually file, if you were filing Schedule C, you would file a separate Schedule C for each of them, because they are basically separate entities. And as far as the expenses, I would probably deduct the expenses of who pays for the expenses. Now, it may be that you purchase patches in her husband's account because you want to qualify. Say you do a maintenance order and you've got 6 months worth of patches, but you actually use them as samples in your business. So you may have to I would probably just keep track of that and then allocate some of that expense to the person who's actually using those patches to apply that against their income. But if it's a minimal amount, then I wouldn't worry about it too much. It just depends how much we're talking about.
Okay, great. Jenny asked the question, is it too late to start, doing our receipts from this point forward? And I would say no, correct? And anytime is a good time, correct, Clive?
Anytime's a good time. And first of all, you probably do have records that you could back up anyway from you existing, because most of us don't pay cash for everything. So there is a record already, whether it's in our bank account or whether it's our credit card. And so, and definitely you've got all the orders you placed through Lifewave, so you can easily get those from your back office. So you have a lot of records that, you know, we live in a world today, there are plenty of records. There's plenty of stuff being recorded, whether you like it or not.
Yep. Debbie asked, can we claim mileage when we have a business magnet on our vehicle? So before you answer the tax yes or no on that, I'm going to let you know, Debbie, it is in conversation with Lifewave that may not be compliant to have Lifewave on our vehicles, because it looks like we are Lifewave. We are the actual corporate company. And so you might want to talk to compliance to see exactly what's compliant about that, because a friend of mine, they're on the edge with her as far as having live. You definitely have to put independent distributor. You can talk about stem cell activation patches, but you definitely want to call compliance about, is it okay if I actually have a Lifewave name on that magnet? But as far as claiming those mileage, what do you think, Clive?
Okay, so just because you put a magnet on your car, that doesn't make it a business vehicle. So it's going to go by the business mileage that you use, what you can write off. Now, if you have some kind of ad on your car and you need some extra deduction, so you figure I'm just going to drive around the block 100 times and therefore I'm going to have some extra mileage, that would probably count as a business deduction. But just say, if you can't back up what you use the car for business-wise, the fact that you have a magnet or some kind of add-on is probably not gonna work. So, you know, the thing about tax deductions, especially in a small business like this, you know, if you ever audited, just remember that the person that you're sitting across from is you want that person to think that the stuff that you're deducting is reasonable, and that and so you don't want everything that you're deducting to be out of the box, totally out of the box, that they begin to suspect everything, because you could be right, you could be justified in what you're doing, but one of the things you do want to avoid is you want to try, if you ever audited, is you want to try to resolve them as quickly as you can. And I don't mean quick in terms of it can take a while, but you don't want to escalate it and have to end up at tax court, because it'll never be enough money to save. So, but my experience has been that if you have a legitimate business, you work in it, you keep the basic records, you may not be able to back up every single record, just because you only one person, there's only so much you can do. But you'll get most of everything that you deserve, that you should be able to deduct, even if you audit it. So, but don't stop taking deductions because you may be audited, because that's not a good enough reason. And of course, don't overdo the deductions because you may never get audited. So just keep it in balance.
Sounds beautiful. Someone asked, if someone has Social Security disability, are you still allowed to have LLC, or will the LLC affect that or kind of flag the disability? Are you aware of that?
Okay, so if you're getting disability, Social Security disability, so there are some restrictions on what you can earn. You may be able to earn some money. So you have to look at what you're allowed to earn. So when you're looking at what you're allowed to earn, it's going to be your income less your expenses. It's not going to be your gross commissions or bonuses you receive from Lifewave. It will be after all the expenses. So you may be able to earn $1,000 a month. And so, you know, let's just say that means you could probably earn $2,000 a month from Lifewave, and after expenses, you have $1,000. So I wouldn't say you can't work, but you have to look at what are the terms of your disability are, because you don't want to have somebody, and even if you set up an LLC or a corporation, you don't want to jeopardize that disability income you're receiving, because even they may look past that corporation and see that there was the intent, the reason for doing it was just to avoid the disability rules. Now, if you're making a lot of more money from your Lifewave account, then maybe it's a time to consider that you're not really disabled in terms of your income potential, and you have much more income potential than being limited to what Social Security disability pays you. So, there's more than one way to look at it than just taking the Social Security disability. But everybody's different. But there are rules where you can earn a certain amount of income, and so you can obviously find that out and then plan your business accordingly.
Okay. Next question. Is it true that you need to make more money with your business than your expense? I believe, is that your question, Debbie? You can unmute yourself.
Definitely, that's it. My son told me no, Mom, because I bought all kinds of stuff before I started, the chair, the copier, the computer. He's like, Mom, chill out. You're not going to be able to write that off. But then I'm hearing Clive say that maybe I could keep it for next year because I'll have more of the business going, because I got a lot of stuff right in the beginning.
Okay, so it's a good question. So, you could start your business could start the day you sign up as a brand partner. You don't need the income to say you're a business. That could be the day you decided to do it as a business. You became a brand partner. You got some. Now, talking about products, maybe your first order of products would be a good sample to deduct. That you wanted to test the patches out to see how they worked and how you apply them, and got to know about the products before you, in order to move forward successfully. So that initial order may be deductible. Now, I just want to qualify that. If your initial order is a diamond order, we only have, I think, 10 or 11 patches. And you don't need to test every single patch to know that they work. But you may want to test 4 different kinds of patches. So, a silver pack would probably be a good example of writing that off. But I would say that if you got a diamond pack and say, I'm going to test out all, I don't know how many you get with a diamond pack, but you get quite a bunch. That would be a little bit a stretch. Now, getting back to your question about you bought a computer or you bought furniture or whatever it is, if you buy it after you start your business, you can actually write that all off in 1 year. Now, you may need some income to be able to write it all off, but if you don't write it all off, you can carry it forward to the next year. If you buy, but you may have furniture you bought the previous year before you even got in business, because you wanted a desk at home and you wanted a computer, whatever it is. So how do you write that off once you already bought it prior to that? Well, there's a way to write it off, but it's not as good as doing it after you get into business. But you just have to take the value of it, the lower of the cost or the lower the value. So if you bought a computer 2 years ago, it's not going to be worth what you paid for it. So there are some deductions that you'll be able to write off from the expense. But if you started and then you got a computer or you bought a desk or you bought a chair, and these are all for your business, it doesn't matter whether you have income or not when you first started. So basically the first 2 years you can show losses, but then you want to start showing some profits.
Thank you so much. I appreciate that.
Okay, and the next question, can you use Lifewave prepaid card for all your business expense? And just to let people know first that whatever goes on that prepaid card, let's say, for instance, you want to transfer it to your checking account, you cannot move it from that prepaid card. You can only use it for just like a debit card. That's the only thing you can use it for. You cannot transfer any money off of that card once it's on it. But that being said, Clive, I would presume that would be a yes, correct? You can use your Lifewave prepaid card for all your business expense?
You could use it for all your business expenses, but remember that the income that went onto that card is you're going to get a 1099 for it. So you're going to show income. So on that Lifewave card, and I haven't used it personally, so the question is, how do you keep track of your expenses on that card? Now, if there's a way for you to be able to download copies of it, that you need to be able to track what you're spending, what business expenses you're spending on the card. Just because you say I use the card for Lifewave, that wouldn't qualify the expense. You'd have to actually document the expenses. So sometimes on a card like that, you don't have access so easy to what your expenses are, and you also don't have the access, not always, of being able to download your expenses into a software program. So for example, when you have a credit card and your bank account, you can use a program. There's Quicken, there's some other Mint, there's a few others that are pretty inexpensive that will allow you to download all the transactions. And so everything can be downloaded and you just sort them in terms of what are business expenses and what aren't. And so my only concern about using the prepaid card for business is how you keep track of all the expenses. And it's not good enough to say, well, I used them for business without having a record. Now, if you don't use it for business, then it doesn't really matter because it's just considered income when it's actually earned, not how you spend it.
Got it. Thank you. So Jenny, you asked if we did get a magnet fee on the car, would that magnet be a business deduction? I would, yes, correct?
Yeah, yes, that would be a business deduction for sure.
Right. Okay, so when we bought into the business with a package, that first initial package is deductible? Question mark.
Well, kind of answer that depending on the package. So, just if you tell people that first package is deductible, some people are going to buy a diamond package and then they're going to think that everything in that diamond package is deductible.
Mm-hmm.
So, no, it would be if you gave away everything as samples.
Mm-hmm.
So,
okay.
You could, even a gold package, you may say, I'm going to use these four patches as for my own testing and for my own purposes, and I'm going to use the rest as samples, and then just keep track of the samples. I don't think you have a big problem with that. I think when you start going into the higher packages, you've got to have reasons why you're going to be able to deduct it.
Mm-hmm.
Up to the gold package, I think not too difficult.
Right. Okay. Question also from Jenny: do you have to find an accountant who knows direct marketing companies? I'm going to answer that. So I would say yes. So I have a very good accountant. I had a very good accountant. She's a wonderful, good friend, and she's extremely thorough. But guess what? I made more money last year than I did the previous year, and I came across Clive, and Clive did my taxes for last year and saved me a whole bunch of money. I'm actually paying less than I was the previous year. So I would say yes, it does definitely benefit. Now, Clive, with that being known, is it just general experience like yourself, because you've been involved with direct marketing companies, that you just happen to find all those, little, all the idiosyncrasies of how to save money? Or is it actual certain people like CPAs who take the extra training for knowing about direct marketing companies?
I think you have to look at the practical side of the tax accounting business. When you first start off and, you have maybe income of, let's say, $10,000 or even $20,000 and you have some expenses, in the bigger scheme of things, it's a very small business. And you come to your preparer during tax season and he or she doesn't have a whole lot of time. So they're going to take what information you give them, and my concern is they're probably not going to ask you for enough other information that you can deduct that would make a difference to somebody that actually knows the industry. So I can talk from my personal experience. I have, I had initially, when I first got started, I got a lot of clients from network marketing. So I did a lot of seminars. I did a lot of, and so I basically knew the questions I wanted to ask. I knew what information I needed to get from people. And even when they didn't tell me stuff, I knew enough about how their business operated to know. See, so your accountant may not know that you give samples, because a lot of businesses don't give samples. He or she doesn't know about samples, for example. So Yes, I think it's so. I think at the least you should do is at least try to talk to your tax preparer when it's not in the month of March and April. Talk to them in November or December or October, and you'll get a better idea. And let's see if they can help you with the kind of deductions you're looking for. Maybe I'll have to rewrite. My tax book is probably needs to be brought up to date, but basically that would give you a lot of information that you could actually go to your accountant with and say, here's some of the stuff I think I can be deducting. So, but the other thing too, and I'll address this about TurboTax. A lot of people do use vehicles like that, which are good to a certain degree, but they don't ask you for information that you don't give them, typically. So it's the information that you're not aware of what you need is what can save you a bunch of money. Now, if, for example, you're making, and there are people making $200,000, $300,000, $400,000, $500,000 a year or more, your tax preparer will take the time to ask more questions, usually, and try to find other ways to help you save taxes that can make a big difference. So, but again, you're talking about the person that first gets started. We all start off the same way. Nobody starts off making, $300,000 right from the first day they start. Some people make it faster than others. Some people take a little longer, but the reality is it's still a business no matter how fast and how you do it.
Great. One question, would you suggest that we play quarterly taxes to avoid interest at the end of year for filing time?
Okay, so this is a question about estimated taxes when you're self-employed. So it depends how much money you make. So if you're just starting off, you probably don't have to worry about estimated taxes. If your income is starting to get up there, what you probably want to do is, at least put aside some money for taxes, because one of the hardest things at the beginning is or when you're self-employed, is suddenly you have to come up with big tax bills come April. So what I think is good is as you see your income starting to go up, then you should have what I would do with somebody, I would probably do a little projection and say, okay, let's project what your income is going to be and after expenses, and this is what the amount of tax you're going to owe. So either you need to make estimated tax payments or you need to put the money aside. So come next April, that it's not going to be a big surprise, because and that's what I would do with anybody that if I have enough, if they become a client early enough in the year. Obviously, they become a client after the year's ended. It's a little different, but I try to do a projection and say, let's take a look, and maybe we have to do another projection in December or November, and just get an idea of what your tax obligations are, because it's not fun for me to call somebody up on April 14th and say you owe a big amount of money that you haven't planned for. So it's just part of good planning.
Lisa, why don't you unmute yourself? Lisa Petit.
I'm trying.
There you
go. So I did have a couple of meetings with my tax guy so far, and to your point, Wendy, he didn't have a lot of experience in this, but he did tell me that if I am self-employed, that if I do owe taxes, that I will end up paying an interest fee at the end, like a 5% or some interest amount if I did not pay them quarterly.
Okay, so let me just explain a little bit about quarterly taxes and estimated taxes. So estimated taxes, it depends on what your income was the prior year. So if you're looking at 2023, you look at your 22 taxes. So let's just say, I'm going to take a simple situation that you are a W-2 employee. You're working for a company, you get your paycheck, they take out the taxes, and typically you have a refund. And now you start your Lifewave business and you're making money. So the way the estimated tax payments work is that there's two safe harbors, they call it. One, if you pay, let's say your tax last year total tax was $5,000. As long as you have withheld $5,000 in your present paycheck, then you're not going to have any estimated tax penalties, even if you owe $20,000. So that's the one rule. So you look back at what your previous year's tax is, and if you had as much tax taken out, then you'll be covered. If you have over a certain amount of income, you need 110% of that. But besides that, the other way is you take your 23 taxes, and as long as you've paid in 90% of it during the year, there's no estimated tax penalty. Now, as far as the estimated tax penalty, it's 5% a year. So let's say you were supposed to pay in $500 a quarter for 4 quarters, and you didn't pay it, and you pay it the following April. So roughly you owe $2,000. Basically 5%. Basically, if you spread that out over the year, because it's only from each quarter, that's about $1,000 times 5%. So you owe about $50 in interest. So, I would say unless you have a lot of income coming in compared to the previous year, I wouldn't really get too upset. I wouldn't worry too much about the estimated tax payments, whether you pay it or not, because if you have to pay $50 or $75, even $100 in interest, it's not really something to be overly concerned about, in my opinion. But I wouldn't lose sleep about that. But you can, but I would want to do is at least let you know that maybe you have a potential of owing $2,000 in taxes, and you want to put that aside for April so that you have it. And then once you have a little bit of a track record of what's happening in your business, it's easier to project what your estimated tax payment should be.
Okay, so in my case, you kind of described it. I have a salary job, full-time job, so I do pay my taxes. So in my situation, I probably wouldn't have to do any prepay. But if I did not have a job last year at all, and this was my new job in the 2023 year, and I'm making these numbers up, maybe I end up owing $10,000 in taxes throughout the year. For that situation, is it wise to make the payments quarterly since you had no income the prior year?
Okay, so if you had zero income the prior year, but let's just say you paid $1,000 in tax the prior year. So your estimated tax payments would be based on $1,000, which would probably be like $25 interest. So, I wouldn't, now, once you have the business operating and like if I go with Wendy, for example, as an example, I know what she earned in 2022 and what she projects to earn in 2023. So you're going to set up estimated tax payments and know what it is. So the hard part is if somebody starts off today, they don't know exactly what's going to happen a month from now or 3 months from now. So I would just say that I wouldn't worry about estimated tax payments if you're just first starting off in Lifewave. And as your checks start growing, then I would see about whether I should pay estimated tax payments or not. Because typically you're going to have expenses that are going to reduce some of that income anyway.
All right. Thank you very much.
Okay, thank you. Sorry. Thank you, Lisa. Jenny asks, if I go to an accountant to ask business questions, if they charge me, will that be a tax write-off? Generally, they don't. Do they, Clive? Just to be asked questions?
Well, it depends on who you go to. So, somebody then let's assume they do charge you. They charge you for a consultation. Mm-hmm. So that would be pretty straightforward as a business expense.
Yeah.
Pretty easy to deduct. So let's say, for example, you go to have your taxes prepared and they charge you $350. So what you do want, you want them to allocate on the invoice how much is for business and how much is personal. Because the amount for the personal tax return is not deductible, but the amount for the business is. So that would be what you'd want to have done, because obviously when you're having your tax return done, some of it is personal, some of it's business. Maybe the majority of the time is taken up on the business.
Okay, great. Let's see here. Okay, so Gayla, you asked, what if you are on just Social Security? Well, we answered that question a little bit earlier. So,
Okay, so if you're asking about how much can you earn if you're on Social Security, which is if you haven't reached the full retirement age yet and you're collecting Social Security earlier, you know, there's a limit to how much you earn before they take back some of your Social Security. So, but just remember, whatever you earn, it's not what Lifewave pays you, it's after you deduct all your business expenses is what your income is. So, you know, you may earn $20,000 from Lifewave, but you've got, say, $10,000 of business expenses. So now you have $10,000 of income, and maybe you can earn $10,000 of income without having your Social Security affected.
Okay, great. All right, so guys, we're going to start wrapping this up. So if you've got a question, ask it now. Other than that, Clive, so we've had a few people who would love to talk to you personally, probably because they want to employ you if possible. Are you at this time taking anybody? And if so, how would, yeah, let's ask that question first.
The answer to that is I actually have a very busy tax practice.
Yeah. Yeah.
And the good part is I've got a lot of good clients and they do refer a lot of people to me. So, and I have not yet figured out how to say no yet. So I guess the answer is I'm still taking people, and but I will be happy to do a consultation with somebody and answer questions personally. And typically I don't charge somebody unless it's a very detailed tax thing and I have to go and do some research. But if somebody would like to just ask some questions and maybe it takes 15 minutes, they're not going to get a bill from me. The only thing I do have, I have a deadline of October 16th, which my wife has shortened up on me because she's insisted I come to the Lifewave conference. So I have to try to get my work finished by the 11th. So she's taken away four or five good business working days, but I'm sure it'll be worthwhile. But so after the October 15th or 16th, or if you see me at the conference, I'll be happy to meet with you and answer any questions you have. So
what's the best way
conference? Yeah, that's the extra bonus. If you're there and you find me, I'll be happy to answer the questions you have.
Beautiful. What's the best way for them to get a hold of you? Would you rather email?
So you can email me. It's clivecpa@gmail.com. Or you can give me a call and you know, I will call you back if you do happen to get my answering.
Okay, and let me get that number out for them. And okay, Debbie, you had a question. Go ahead, unmute yourself.
Oh, he answered it.
Oh, I did. Okay.
I want to be my tax man.
He is great, that's for sure. Okay, so his telephone number, guys, is 858-523-8075. And of course, be respectful. You don't want to take up Clive's all his time. Keep your questions minimum if you do call him. And it's in the chat, both his email and his telephone number. All right, Clive, if you want to stop sharing screen. Great. Okay.
Was that 05 or, I mean, 25, I mean, 75 or 25 at the end?
It's 75 at the
Okay.
end, 8075.
Thank you.
All right, so no more questions? Going once, going twice? All right, you have a lot of people saying, thank you so very much, Clive. You are such a wealth of information and always coming from your heart. I don't feel that. I'm sure we all can feel that too. And thank you for making it so very, very clear. Yes, just honored to have.
I look forward to meeting some of you at the convention. So, which is tax deductible, so it's a good reason to go.
Exactly. Well, thank you so much, Clive, and thank you, everybody. And next week is the personal development, and we're going to have our very own Sheila Hay sharing her story of what brought her to where she's at today. So make sure you come in next Tuesday, and she will be our guest then. Again, Clive, thank you so very much. Really appreciate you.
Thank you, Clive. Amazing.
Bye-bye.
Thank you.
Thank you
Thank
so
you,
much.
Wendy. Thank you,
I'm
Wendy.
I'm clapping. It was so good.